Hello, everyone. Welcome to today's webinar, 2021 Economic and Financial Market Review to Home Stretch with Scott Knapp, Chief Market Strategist, CUNA Mutual Group. Let me turn it right over now to my colleague, Melissa Pomeroy. Melissa, it's all yours.
Thank you, Walter. Thank you, everyone, for joining and making time today. And welcome to part 2 of our CCUA CUNA Mutual Group webinar series. Today, our topic is 2021 Market Outlook, what to expect in a post-pandemic adjustment period. We are joined today by Scott Knapp, as Walter mentioned, Chief Market Strategist from CUNA Mutual Financial Advisors. Scott is responsible for development of the firm's overall investment philosophy and implementation of programs that help institutional and individual investors meet their objectives. He chairs the firm's investment committee that approves strategy and oversees the firm's investment operations. He is also a member of the firm's capital markets committee that performs ongoing research on the global economy and financial markets. Scott is also an active member of the CFA Institute, the CFA Society of Madison, and the National Association for Business Economics. He's an adjunct professor of investments at the University of Wisconsin-Madison, and he serves on the board of directors for Madison Ballet. We're very appreciative of our partnership with CUNA Mutual Group and of their commitment to the credit union movement. And we're very fortunate to have Scott join us today, presenting on what is a very relevant and important topic to our industry. Scott, thank you very much for being with us, and I will pass it over to you.
Great, thanks very much. I really appreciate the invitation. Great to be here. I'm actually sitting in a very sunny hotel room in Florida, which is different because I jumped on an airplane to come down from Madison, Wisconsin just yesterday, and it was 30 degrees. So we are heading into the home stretch of the year. Well, I must be having fun because this year has absolutely flown by. It has really been amazing how quickly things have transpired and how quickly the year has passed here. Yeah, you see the title here. It's the Economic and Financial Market Review. Post-pandemic adjustment period is actually a phrase that I stole from the St. Louis Fed. They actually said that we are entering into a very anomalous period in the global economy because we are shaking off a pandemic, which is just such an unusual circumstance that a lot of the data that we're seeing are hugely anomalous. And they dubbed it the pandemic adjustment period. And that's where that's kind of where dealing with today, a lot of the distortions that were created by COVID. It'll be great to get this in the rearview mirror, but we're not quite there yet. But we are in the home stretch. Before I get too deep into some of the details, and gosh, I've got so many data points and charts and graphs to show you and so forth, I want to set the tone for the conversation, because sometimes when we you deal with, yeah, let me see if I can shrink this here real quick, trying to get this to shrink. Yeah, so I'm only seeing about half my screen here, but not a problem. When you're dealing with so many data points, charts and graphs, and when so much of it is so anomalous, sometimes you miss the forest because of the trees. So what I'd like to do is just talk a little bit about the tone I'd like to set during the course of the conversation here today. First of all, financial markets and the economy are highly distorted. They're very, very distorted right now. Not only because of the pandemic's influence, but also because of the monetary and fiscal policy responses to the pandemic. And actually, some of these have been pretty experimental. They're not policies and processes that are time tested. Some of them were used in the post-global financial crisis period, but they really got put on steroids after the pandemic started to take its toll on the global economy. And as a result of that, a lot of the data points that we're seeing right now are quite distorted. And this is not something that's lost on your credit union members. I'll give you one example. So if a credit union member comes into the lobby of a credit union and got some cash to invest, yeah, he's got to get it working, because he just saw in USA Today that year-over-year inflation was 5.4%. So consumer prices rose 5.4% over the last year. He's got to get some of this money to work, put it to work so they can offset the effects of inflation. He looks at the CD board, and he sees that the yield on the 3-year CD is 30 basis points. And he sees that he will be locking in a 5 percentage point plus loss in value by buying a 3-year CD. And that is something that gets our attention, especially if they've spent $4 a gallon for gas to put in the car to get to the credit union. It really is distorted. lots of anomalies are taking place, and it's not something that's missing just because of observations that the average credit union member is making on a daily basis. One of the key themes here is a deceleration, which is clearly happening in the economy. It's not the same as decline, although the former can feel like the latter. So I'll give you another analogy here. So I used to work in #2 World Trade in New York, and I worked on the 103rd floor. And to get to the 103rd floor, we had to ride an express elevator up to the 78th floor. Then we transferred to another elevator bank and go all the way up to the 103rd. Well, that express elevator was really quite a work of technology. It was a very, very big elevator. We would all jam onto it, and this thing would shoot like a rocket higher. And as we started to approach the 78th floor, it would start to decelerate. And because we didn't have visual aspect, no visual reference points while we're riding this elevator, as it started to approach the 78th floor and it started to decelerate, you could swear you were falling. It created this distorted feeling of falling, even though what was really happening was we were just merely decelerating as we were trending up to the 78th floor. And that's an important observation or an analogy for what's happening in the economy right now as it decelerates. Not decline, but it is definitely decelerating, and that's something that we're going to have to deal with. Right now, inflation continues to be the biggest wild card for financial markets. I really wish we could talk about something else other than inflation, but it is very much front and center in the discussion today because it is the biggest wild card for financial markets. Just one quick clarifying point. The Fed has no idea if inflation is transitory or if it's entrenched. Now, they've been going with the transitory, it's another word for temporary, for over a year now, and saying that, yes, we are seeing inflation, but it's temporary. It's just due to some pent-up demand being released and because of some supply chain disruptions from the COVID crisis. But all of that's going to pass. Inflation is transitory. Well, they really don't know if it is or not. Inflation is actually pretty much a mystery. There are several different theories that explain inflation, what causes it, what the effect is, what the remedies are. None of them has it nailed down. Inflation is very much a mystery. So the Fed doesn't have insights in it that anybody else has. What they're trying to do is anchor expectations. And I'll share with you why later in the presentation about why they're doing. They're trying to set expectations rather than really predict the trajectory for inflation. And it is the elephant in the room. We just can't get away today without talking a lot about inflation. As always, there are compelling reasons why markets can go higher from here, compelling reasons why they can go lower. That's always true. Right now, investors and economic participants, whether they're investors or not, are highly susceptible to overshoots. Earlier in the year, we had this burst of optimism, this incredible burst of optimism. And now you're starting to see a lot of that is leveling off, and we're running the risk of tipping over to a burst of pessimism. I'll show you what that means in just a few seconds. We're clearly in an environment where both positive and negative overshoots are higher probabilities. So our job today is just simply to assess probabilities, set reasonable expectations, not make predictions or place bets. You might, from time to time pass through CNBC or Bloomberg on TV, and you'll see people going on TV and they'll be setting like price targets for the S&P 500 for the end of the year. Our price target for the S&P 500 at the end of the year is 4,800, or maybe even end of year yields for the 10-year U.S. Treasury security. Our yield target for the end of the year for the 10-year U.S. Treasury security is 1.75%. All done for entertainment purposes, folks. It is not something that is of much value. It's all done simply to get attention on financial media. These are very, very difficult things to predict, and as such, we just need to look at the range of possibilities and assign probabilities to those possibilities rather than make hard and fast predictions. It just simply doesn't work. So with those tone-setting comments in place, let's go ahead and turn to financial markets and get a sense of how they performed. Again, I'm only looking at about 2/3 of my screen here, so I might be missing stuff. This is major asset class returns as of the end of third quarter. So as of September 30th. You can see the asset classes listed in the asset class column, coincidentally, and large cap stocks, mid cap, small cap, international, emerging market stocks, investment grade bonds, high yield real estate. And you really don't even have to dig very far into the numbers themselves to get a sense of what's happening. So you can just scan your eyes from the right side to the left side, and you can see that there was a loss of momentum in the third quarter of this year. So the green numbers, as you move from right to left, coming closer to the end of the third quarter, started to turn red, and there was definitely a loss of momentum. Now, it was pretty highly compressed in September. So September was a pretty tough month for financial markets, but we really shouldn't go overboard. We've been waiting for a meaningful correction for an extended period of time because these markets just have been on an absolute tear. They have really been rising quite nicely, way above trend returns, and we've been expecting a correction of some sort for an extended period of time. And it looks like we got a very small one at the end of the third quarter. So nothing to get too terribly excited about from an overall market perspective, but it was definitely a loss of momentum. And it was pretty concentrated in what we call higher duration investments. So I got an arrow pointing to large cap growth stocks. These are like technology stocks and a few other types of companies that we call long duration, very sensitive to interest rate changes. And that's where most of the damage was done, was in those longer duration securities. Now, this is markets in the aggregate. These are the indexes that you can see them listed on the left-hand side, the asset classes they represent. So it was pretty quiet, actually a really good year, but really, really quiet, at least on the surface. So let's dig deeper into the stock market. Now, why the stock market, not the bond market? Bond market is much larger than the stock market, as you know. Why the stock market? And that's because most of your members rely heavily on the stock market for their overall investment plans. So let's dig deep into the S&P 500, the stock market, and look what was going on there during the course of the year. And here it is. So you can see the different sectors that make up the S&P 500 listed on the left-hand side. And then you can see the returns, and they look a lot like the previous slide. But what you don't see, though, is that there were major rotations taking place. Almost violent corrections were taking place within the market. The market itself masked it, because when there was a big sell-off in one set of sectors, there was a big rally in the others, and then they kind of reversed. So in the aggregate, it looked really quiet and really calm during the course of the year, but there wasn't a period of time, or there are very few stocks in the S&P 500 that weren't down at least 10% at some point during the course of the year. Some of them down even 20%, as these violent rotations took place inside the stock market, but were masked by the index returns. And most of that rotation was taking place as a result of the changing outlook for inflation. Inflation was a big driver of the financial market returns on an internal basis. I'm going to go deep into inflation in just a few seconds. Just be aware that don't let the surface returns of the financial markets mask the fact that there was a lot of turmoil inside the markets during the course of the year. And at the end of the year, we actually ended with something we're calling the reflation trade coming back into vogue. What we mean by that is these sectors that we think will perform best in an inflationary environment were the ones that substantially outperform. So look at the two arrows I've got to the left-hand side. You can see that the top arrow is pointed to the financial sector, and the bottom arrow was pointed toward energy. Now let's scan your eyes to the right. You can see the one-year returns, and you can see they were, wow, look at these returns. 59% on a one-year basis from September 30th, 2020 to September 30th, 2021. 83% for energy stocks. Rallied like crazy. Now the key point here is that they were left for dead in the wake of the COVID crisis. These two sectors got clobbered, absolutely crushed. And now they are by far and away the biggest winners, likely attributable to belief that the economy has accelerated to the point, or has become inflationary enough to the point where these two sectors would benefit most from a reflationary environment. And that's clearly playing itself out in financial markets. So let's dip away from the financial markets and head toward the economy itself. So this is a chart that shows real GDP, and this is a percent change from the previous quarter. That's the methodology. And you can see that it's kind of chugging along. The scale really got distorted here because of how big these two bars are here. But normally, it kind of chugs along at about 2%, 2 to 3% real GDP growth on an annualized basis. And then all of a sudden, pow, you can see this utter collapse in the economy that happened in the second quarter of 2020. That's the COVID crisis. You see a little bit of it in the first quarter, but the second quarter really bore the brunt. But just like a rubber band that got stretched to the breaking point, it snapped back very quickly, very, very quickly. That explains a lot of these violent rotations taking place inside the markets. So it went from here to here. So the distance between these two bars is really quite dramatic. This is something you just simply don't see in the US economy. Highly anomalous conditions, post-pandemic adjustment period is really, really distorted, highly distorted. Now, some news here, old news here, this is kind of backward looking here, but the news here is that the second quarter 2021, real GDP came in at 6.5% annualized. That's about 3 times our normal run rate for the US economy. That's the second quarter of 2021 annualized. So 6.5% annualized, and that's more than 2 percentage points lower than expected. So while it was more than 3 times our normal rate, it was more than 2 percentage points lower than expected. The Fed was actually expecting, at least in the early days of 2021, that we would end the year at about 8.5% real GDP growth. All of it because of a snapback, because of this rubber band snapping back to its normal shape. But they've come down a lot, and they actually came down, again, you'll see at the bottom here. Third quarter consensus estimates, which are actually going to get the first read on third quarter GDP on Thursday, so day after tomorrow. And look how far it's come down, 4%. Remember, we started the year at 8.5%, and now consensus expectations, at least for the third quarter annualized, is 4%. That is a very big deceleration that's taken place. Same thing with the Fed's forecast. They actually went from meeting to meeting. In their June meeting, they said that they expected the year 2021 to end with a 7.1% real GDP growth. They dropped that down to 5.9%. And if you know anything about the size of the US economy relative to how these data points work, you know that that is a very big drop. So there's clearly deceleration that's taken place. A lot of commentary about the Delta variant being very much involved. And I think that that's probably true, but it doesn't explain the whole scenario. There's something called reversion to the mean taking place, the rubber band snapping back. The elevator is starting to approach the 78th floor. That's what's also happening inside the economy itself. So let's continue on this path by looking at the unemployment rate. And here you can see how unusual the economy actually was in the last year. So this is the unemployment rate. This is the U3 rate. And look what happened when COVID struck. It spiked higher. You just simply don't see this in the US. Now here's the financial crisis. This is the recession and the financial crisis. By the way, look how short this recession was. Look how short the COVID recession was relative to the financial crisis. But here what you see is an increase in the unemployment rate. And this was a financial crisis. This was a very, very big pickup in unemployment in a very short period of time as the Lehman Brothers situation collapsed. But then you can see this kind of steady climb out, the reductions in the unemployment over an extended period of time. Well, look how different this is. It was straight up. This was really extreme by normal standards. This was unheard of. This is just a straight up spike up in the unemployment rate. But look at it was like it hit us like a Super Bowl hitting concrete. Down it came. Down, 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 down. But notice that it's starting to taper off. Now, there's a little hook down here where it really dropped to 4.8%. Dropped a lot in the last month to 4.8%. Sadly, that's for not the right reasons. I'll explain that later. But what you definitely see is a moderation in the pace of recovery. It's likely going, the slope that you see here is likely going to be where the slope goes from here as we continue to improve in the labor market. So the elevator is approaching the 78th floor. It's decelerating, and it can create a distorted point of view that we're actually entering into a period of decline, when in fact we're not. The elevator is not falling, it's merely rising at a slower pace. And no doubt that that's happening, and it's showing up in the data itself. So what's really going on? Well, this chart depicts it quite nicely here. So what you're seeing here is a few things. First of all, the gold line. Let's start with the gold line here. That is the expectations for the rate for GDP in the United States back in January of 2020. So this is pre-COVID. Here comes January 2020, and it kind of extended that expectation all the way into the future. And you notice it's very smooth. The trajectory is very smooth, and it's kind of not very steep, not very sloped. And that's what the expectation was for GDP going into the COVID crisis. The dark blue line here was actual GDP, what we actually experienced versus what the expectations were. And then you see this dashed line here, and that's the outlook. That's the forecast. Now notice over here what the scale is. The scale is not percent change. It's actually the dollar size of the economy itself. So if we want to measure the percent change or the pace of change, we would look at the slope of these lines. So let's take, for example, this gold line here. It's kind of just chugging along, Lower left, upper right, really stable. I don't know, what is that, about a 30-degree angle? I don't know what it is. But if nothing else, it indicates that it's not a rapid change. It's about 2 to 2.5%. And it was likely to persist into the future. They thought it was going to be just a nice, steady, continued growth rate. But what we got was this blue line. That was expectation, but this is what we got. So let's have some fun with this chart here a little bit. First of all, let's estimate where we are right now. Let's look at GDP on a dollar basis relative to where it was when the COVID crisis started. And you can see that we have risen above where we started the COVID crisis. So on a dollar basis, the total value of goods and services produced in the United States are now more valuable than they were prior to the COVID crisis. That's good news. We've actually pierced this line. See if we get the cursor going right here. Now, the sad news here is, though, is this game, this only tells part of the story. It is good news, but what really matters is where this line is compared to where we should be. And that's this gold line here. It's not necessarily a comparison to the start of the COVID crisis. It's actually where we should have been had we stayed on the current trajectory that we were on back in January of 2020. And here you can see there's plenty of room for improvement still. We still need to improve. We still need to get caught up back to where we would have been had COVID not happened. And that's more relevant. So let's look at that gold line more closely, and let's look at the slope here. Here's the slope. Again, I don't know, about 30 degrees, really steady. The slope of the line is kind of shallow, meaning we were growing at a slow pace, 2.5%, but really predictable, really steady. Expected that to continue into perpetuity. Looked really good, kind of producing some modest economic data as we grew at this pace, as indicated by the slope of the line. But then the bottom fell out. This happened. Again, the slope of the line is what matters here, and the slope indicates borderline apocalyptic economic conditions. This was a falling out in unprecedented ways that we experienced in the US economy, straight down almost. And the economic data that were being produced at this point were just absolutely dramatic. We were seeing deflation, plummeting corporate profits. We were seeing unemployment rates rise dramatically in ways that we never thought were possible. All of that was happening during this period of time. And it really created a sense that we were just absolutely falling out and we were heading toward borderline apocalyptic conditions. But you know that we can't stay on this trajectory forever, not in the US economy. And we needed a quick catalyst, and we certainly got that in two forms. First of all, a ton of stimulus, tons of stimulus from both fiscal and monetary authorities were applied to the economy. But then we got news about vaccines and how effective they would be. And what happened? That happened. Absolute opposite conditions. We spiked straight higher. The express elevator is launching toward the 78th floor. Up it goes. Economic data that were produced during this period were dramatically positive. We were even hearing people and pundits start to call this the return of the roaring 20s. It wasn't the return of the roaring 20s at all. This was merely a quick reversion to the mean. This was the express elevator heading up to its ultimate destination in the early stages of its climb out. Now, the economic data that were produced here compared to economic data that were produced here did nothing but amplify the perspective that the economy was in this breakout phase, this amazing breakout phase like we'd never seen in our history. And optimism spiked. We saw stock markets run like crazy, valuations get nuts. We saw speculative excesses starting to enter in financial markets in ways that we hadn't seen for an extended period of time. And a lot of it was aided by newly printed dollars from the Federal Reserve. Well, guys, you know what's going to happen, and that is the express elevator is starting to approach the 78th floor. It is starting to decelerate, and here it goes. So the slope of the line is becoming more shallow. This is the normal course of business for an economy the size of the United States. We are reverting back to the mean, and that process is well underway, and we're starting to decelerate. Natural, normal conditions, but just like the express elevator, it can be misinterpreted as we're about to enter a period of decline. The elevator is falling. No, it's not. It's just rising at a slower pace. Now, compare that then to their original starting point, you can see that that deceleration process still has a way to go. Getting back to normal, which is our most likely scenario, is probably going to be a work in progress, probably for at least the next year. Now, the good news is we're well underway. So here's the Citigroup Economic Surprise Index. So it's quick explanation here. So you see this horizontal line here. This is when economic data and expectations for that data match each other. So like say, for example, if the unemployment rate is expected to be 5%, you get the unemployment rate released and it's 5%. That means that would plot right on this line. The expectations and the actual data matched. When it goes below, then that means that the economic data that's reported are below expectations. And when it's above, it means the economic data are above expectations. Here we have COVID. So we have this period of time when it just spiked lower, and every economic data point that we were getting was shockingly negative, and down we went way below expectations. But then, and everybody got very, very dark at this time. Then came the vaccines and the stimulus programs, and then suddenly the data releases shot way above expectations. This is when the speculative excesses really started to move into the meme stocks, Bitcoin speculation. You know the list. It just goes on and on about how this manifests itself in financial markets. But notice that it's come down quite a bit. And it even dipped negative. It got to the point where deceleration was actually starting to create disappointments. But you'll see that it's hooking a little bit higher. A little bit of an old chart. It's back to the 4th. So it's about 20 plus days old here. But you'll see that it looks like it's starting to stabilize a little bit, which means that that deceleration process looks well underway. And it's looking like the economic data and expectations are starting to sync up. And that's good. It just means that there are fewer shocks that are likely in the offing here. Okay, so now all eyes are pointed to this part of the chart, and that is that forecast value. That's that dashed blue line. Will it continue to tip over and merge back onto the goal line? We think it probably will. We think there probably will be continued deceleration. It will not end in decline. It'll end up with the US economy probably toward the end of 2022, looking a lot more like it did in January of 2020 than any kind of breakout either to the high side or to the negative side. All eyes are on the recalibration of the economy itself. And like I said before, the Fed and most economists and pundits are really starting to bring down their GDP expectations. And that just means that that dashed blue line is likely going to continue to tilt down toward the gold line. Okay, so yeah, here's the elephant in the room, guys. There is a wild card in all of this, and that's inflation. And a couple weeks ago, I did a presentation about cryptocurrencies. And it was so nice to talk about something other than inflation for an hour. Yeah, I don't have that luxury very much, guys, because inflation is the wild card that is really driving the conversation, the current conversation, the debate that determines our path forward, and that is, where are we on the inflation continuum? So while this reversion to the mean theme is, we think, the most likely scenario, and we'll talk more about that in just a few seconds here, there is a big wild card here, and it is the inflation story. So let's talk about inflation, but we want to talk about inflation expectations, and in that regard, it becomes a forecast. It becomes an outlook for the future. So before I get into specific details of inflation itself, let's talk a little bit about forecasting here. Now, our approach is based on scientific method. This is not something like you see on TV where these guys come in and make these predictions about what markets are going to do. Nobody knows what markets are going to do in the near term. This is far more based on a scientific method. I'm going to have to do this from memory because I'm missing the left side of my slide here. But this is the process that you follow when you establish a forecast. This is probably something that you do when you do strategic planning for your credit unions. You look at what the possibilities are, you assign probabilities to those, and you make decisions accordingly. So it starts with the establishment of a base case scenario. By definition, this is the scenario that you think is most likely to occur in the future. And then you assign a level of confidence to your base case, and you express it as a probability. It can be something like a % chance, or high, moderate, low. That's the methodology we use. It could be like percent, like a 30% chance of rain. You know, that's a probability. That's a forecast with a probability assigned to it. Then you identify alternative scenarios. So these are alternatives to the base case. Now that you've established your most likely scenario, you identify what the alternatives are. This is very different from making a specific prediction. You're looking at a range of possibilities. You're just probability weighting those. So the alternatives then get identified. Could be one, could be multiple. And then you assign a level of confidence to each of those, again, expressed as a probability. And that ends in a range of possible scenarios. This next sub-bullet, I'm going to have to do from memory because I can't see it here, is very important here. And that is that you make changes and that you monitor trends and then you adjust probabilities assigned to the scenarios as conditions change. We live in a dynamic environment. So your base case and your alternatives and the probabilities associated with those have a trajectory and have a characterization, and all of these things can change as conditions on the ground change. And as stated before, certainty is never achieved with these things, and specific predictions are not made. We also, in our own processes, identify possible outlier scenarios. What is the low probability, high impact scenario that should be evaluated? We also think contrarianism plays an important role. What is the herd missing? What is the herd missing is always an important question. So range of possibilities starts with your base case, probability assigned, alternatives are then identified, probabilities are assigned to those. It's a dynamic environment, so the trajectory and the probabilities themselves get adjusted as conditions change, and then we monitor and make decisions accordingly. So with that process described, here is where we are today. I'm going to have to do this from memory because I can't see the slide. Our base case, and again, by definition, the one we believe is the most likely to occur is reversion to the mean. Again, it's that scenario of the express elevator just decelerating. We're just going back to normal, and it feels like we're falling. It can feel like we're falling. It's just deceleration. It's not decline. Now, the probability that we've assigned to our base case, which is reversion to the mean, is high. We think that this is still, under these conditions, the most likely condition we'll experience in the next year. But the probability is falling. It is falling, and I'm going to explain to you why the probability of their reversion to the mean base case is falling. But what are the details here? Large changes in growth, and growth rates are attributable to the pandemic's unusual influence on the economy. Strength and weakness reflects reversion to the mean, meaning getting back to normal very quickly. Doesn't indicate sustainable breakouts either to the negative side in the wake of COVID or to the positive side when we had that big snapback period. Inflation, yeah, it emerges. In our base case scenario, there is inflation, no question about it. But we believe it's going to be transitory. And in this regard, we are with the Fed. We are with the Fed. We believe that the conditions that we're experiencing are so anomalous and so unusual that they're likely going to go back to normal. And as a result, inflation that we're experiencing right now is likely transitory. Two things have to happen. Supply lines have to reopen. You know, we've all heard stories about supply lines. I'll show you some examples in a second. And pent-up demand from being locked up for a year starts to dissipate. So that's our base case scenario. Probability we think is still strong, that's likely the condition we're going to experience in the next year, but it's falling. It's falling. I'll explain why in a second. Our first alternative to our base case is the roaring 20s ends with the stagnant 30s. And here the probability is moderate. It's a moderate probability that we're assigning to our first alternative to our base case, and it's staying pretty stable. So what are the details? After a quick release of COVID-induced pent-up demand and $1 trillion of additional stimulus dollars, it leads to a period of well above trend growth. So we have this burst of growth as a result of all the stimulus dollars being applied, all this pent-up demand being being just opened up on the floodgates for demand or opened up in the economy because we're no longer locked down. And in this situation, the Fed allows inflation to run hot. They said for a long time they prefer above trend inflation, and they get it, but they get a lot of it. And eventually they fall behind the curve and they have to slam on the brakes with monetary policy. This is a classic scenario in every economics textbooks. They call it the Fed taking away the punch bowl just as the party is getting good. So the Fed has to slam on the brakes because they've let inflation run too hot for too long. And that brings the economy to a sudden halt. So the roaring 20s ends with the stagnant 30s, probabilities moderate and stable. Second alternative is we're calling it the that 70s show, and the probability here is low. It's a low probability scenario, but it's rising. And essentially what it means is 1970s style stagflation occurs. And that happens as the economy continues to decelerate, doesn't necessarily have to go into decline, but prices continue to rise due to supply chain problems. If you recall back in the 70s, a large part of our stagflation was because we had a dead economy and we had rising energy prices and rising labor costs. And boy, does that sound familiar. I'll show you a couple of charts on those two subjects in just a few seconds here. And in this situation, both fiscal and monetary policy response, they just lose their effectiveness. It just doesn't work. Stagflation doesn't get handled well by policy remedies. And as a result of that, you really don't get a big shift in policy responses. So of these three, reversion to the mean, roaring 20s ends with stagnant 30s, and that 70s show by far and away the positive scenario is the first one. And the good news is that's our base case. The bad news is the probabilities are shifting. They're shifting away from the good, the better of the scenarios, meaning our base case. So one question that my portfolio managers ask me all the time is what would change all the probabilities associated with this? And again, I'm gonna have to do this from memory because I can't see my slides here, but what would shift the probabilities among these scenarios? Well, first of all, yeah, an easy one. Enough time passes that transitory inflation is clearly not transitory. I mean, a temporary problem that doesn't go away isn't temporary. It's just that simple. So enough time passes and inflation continues to run hot. Yeah, it's not temporary anymore after a certain period of time. That time is not defined, but we know if it sticks around, yeah, it just doesn't qualify anymore. The trajectory of current trends in economic growth and inflation rates continue. In a second, I'll show you what's happening with growth rates and inflation rates. And yes, tends to support that stagnation, that stagflation scenario a little bit. How about inflation expectations? They continue to run hot, and it becomes a self-fulfilling prophecy. Very straightforward. If you're faced with a choice to buy a car today or buy that same car tomorrow, when you expect inflation, it's a simple call. You buy it today. You don't wait till tomorrow because the price is going to be higher. In the aggregate, inflation expectations brings consumption forward. People start to make purchases today that they would normally prefer to defer. That brings demand forward. Inflation expectations become a self-fulfilling prophecy, and that's a problem. What about energy markets and labor markets? If they continue to be disruptive, if there's any two markets that you don't want to have disrupted, it is labor markets and energy markets, because that feels a lot like the 70s again. And then last but not least, just conditions on the ground. You just look around. Yeah, I'm here in Florida, and I see a gas station across the street here. A gallon of gas is $4. Gosh, I didn't think that was going to be possible again. But just conditions on the ground become really compelling. And it becomes who are you going to believe? The Fed, who says that inflation is anchored and it's transitory, or your lying eyes? The gas station across the street, the $4 gallon price tag. So these are the things that we're seeing in markets, in the economy and so forth that could change the probabilities associated with our base case and the alternatives. So for the longest time, though, I've been able to say with high confidence the markets agree with us and that the data tends to support our situation or our position that inflation is transitory. Our point of view is very similar to the Fed's, and markets seem to be validating our point of view. But that's changing. Markets are starting to say something different. Well, first of all, why does the Fed say it's transitory to begin with? Well, here's a slide that shows that. So the Fed doesn't look at CPI like we do, the Consumer Price Index. They look at a data point called the PCE, the Personal Consumption Expenditures Index. And they break it into two pieces, cyclical and acyclical. So you got the aggregate number, that's the inflation rate as indicated by PCE, and then the components, and they break it into two, cyclical and acyclical. Long story short, and this is a very crude definition, cyclical inflation sticks around. Acyclical inflation tends to be the stuff that comes and goes pretty quickly, and it's attributable to things that are temporary. And you can see why the Fed said that it's transitory. This is where it comes from. Look at the percent of, or the portion of the inflation rate that was attributable to acyclical or not sticky inflation. Most of it, look at that shooting up. Yeah, but that's starting to change a little bit. Look over here on the right-hand side here, the kind of inflation that tends to stick around, that's that blue line. Yeah, it's kind of catching up here, guys. So the situation is becoming a little bit more complicated when the Fed first said that inflation was likely transitory. Yeah, it's starting to get complex. Inflation exists in a dynamic environment. The probabilities, the expectations, The actual influence of inflation, the remedies and its causes are in a dynamic environment and they don't stand still. It can change and shift over time. So this transitory thesis, which sounded really rock solid just a few months ago, is starting to show a little bit of a short shelf life here by this indication alone. Likewise, financial markets. For the extended period of time, I've been able to say financial markets have agreed, but not so much anymore. This is the yield in the 10-year U.S. Treasury security. Now, you can see back at earlier in the year, we had a big inflation scare, and that yield just shot up to about 1.77%, still low on a historical basis. But what matters more with interest rates is how fast they change and on the trajectory in which they change. It doesn't matter so much the absolute levels, it matters more about how much they're changing and how fast. And you could see that it shot up really quickly to 177. Yeah, it started to calm down, transitory, calm down, everything's fine. But look what's happened recently. You can see that it's starting to trend up again. When I made this slide on the 22nd, the yield in the 10-year, which is a bellwether for interest rates in general, was up to 167, again, about 10 basis points below its high set earlier in the year. Today, I think I saw it's about 163, so it's kind of hanging in there a little bit. So markets are starting to, once again, start to think about inflation in ways that they had just a few months ago. So markets are not necessarily completely in the transitory camp like they were just a few months ago. Likewise, the 5-year break-even rates. This is, I want to add some perspective because this looks a lot more dramatic than it actually is. So this is the TIPS market, the Treasury Inflation Protected Securities markets, and discounted into the numbers is an expectation for inflation, and it gets captured in something called the break-even rate. And you can see what that was. It's kind of chugging along. I drew this, this kind of resistance line right here, the long-term average, a little bit of resistance there. And then the bottom fell out right here. This is COVID. We were going to deflation. We were expecting prices to go into a deflationary spiral for the next 3 years or 5 years, and it was just going to really be bad. But then that elastic band snapped back and off went the express elevator, and you'll notice that we blew through the longer term trend line. We blew through it. And then we kind of stabilized a little bit, but now you can see we're trending higher again. So financial markets are not completely onto the transitory case. Now, I don't want to go overboard here. If you look at the scale on the left-hand side, which I can't see, hopefully you can, you know, the TIPS market is expecting about 3% inflation. You know, that's higher than our longer-term trend. The trajectory is up. It looks like it's starting to break out a bit, but let's not go overboard here. It's still only 3%. It's just that the pace of change is still indicating that the TIPS markets believe that inflation is going to accelerate and it's not necessarily transitory. This is the big one. This is commodities. I could take those same lines and just draw it on this same chart here. Trend line, bottom falls out and spikes higher. This is commodity prices. And they are way up relative to where they were even prior to the COVID crisis, just spiking higher. Now, these are input prices. So if you're a company and you're commodity sensitive, this has one of two effects. Either it reduces your corporate profitability because you've got higher costs, or you're able to pass it on to consumers, and that comes out in inflation, in price inflation. Now, there are two kinds of shocks that can influence commodities. One is a supply shock, the other is demand shock. We got a little bit of both, but the one that seems to be influencing commodity prices the most is lack of supply. Supplies are short. Two of the commodities that are very influential in this index that are driving it higher is oil and natural gas prices, and they are up a lot. I'll get to that in just a few seconds. So I got my sequencing wrong here. I'll come back to it in a second. Okay, what about the trajectory of growth and inflation rates? Well, here's the Fed's data from its meeting minutes. So this is the Fed's June meeting minutes. This is from the September meeting minutes. And look what's happening about growth expectations. I mentioned to you that they've come down a lot. They came from 7% to 5.9%. That's a 1.1 percentage point reduction, and that's a big one for the US. What they're expecting for inflation, up. So the ratio between these two is looking stagflationary. Growth down, inflation up. So this is a challenge here. If these trajectories continue on, then that would jostle our probabilities assigned to our base case and to our alternatives. But please keep in mind, that this is still a very low probability scenario. Stagflation is an unusual condition. It's rarely seen, and natural stabilizers tend to prevent this from happening in the US economy. But let's not ignore these changes. It does look stagflationary, at least in its trajectory. We have to monitor this. Let's not take it for granted. What about inflation expectations? Again, inflation expectations can become a self-fulfilling prophecy. Why is the Fed so committed to this transitory thesis? I heard it even last week, where lots of the Fed presidents went out and did speeches, and they just pounded the table again saying inflation expectations are well anchored. And I think to myself, what data are you looking at? What could that possibly, what is the Fed doing? Why are they so committed to the transitory thesis? Is they want to keep inflation expectations low. Populations and publics that expect inflation tend to create inflation. They pull demand forward and it creates inflation. Inflation becomes a self-fulfilling prophecy. Therefore, the Fed is doing its best to convince all of us that inflation isn't a problem. It's going to be transitory, even though they don't know what inflation is going to do in the future. What they're mostly interested in is expectations. And this headline from the Wall Street Journal captures the current state of the state. Here's the University of Michigan inflation expectations chart. This is from surveys, public surveys, and you can see, wow, look at that, up it goes. So inflation expectations, in spite of what we heard last week from all the Fed presidents, are not anchored. They are coming up, and this can become a self-fulfilling prophecy. I'd mentioned oil and natural gas prices. On the left, you see, I think it's WTI. I can't see it, but it's the November contract for WTI. I looked at it today, and I think it's up to like $86 a barrel. I'm not sure what this one says, but I think it's high. Natural gas has come down a little bit from the $6 indicator here. It's amazing to see how much of our productive capacity in the energy space has been reduced in just a short period of time post-COVID. And it's leading to a debate called greenflation. And that is we're reducing our ability to produce energy. That's translating into higher prices, which is taking input prices higher. Inflation in general is rising because of reduced capacity to produce energy certainly in the United States and also around the world. So not taking a position by calling it greenflation, I'm just saying this is the debate. This is the debate that's happening here. Okay, labor markets. As I mentioned, energy markets getting goofed up is probably a big deal. It's 70s-ish. Let's talk about the labor markets. Yeah, the civilian labor force participation rate. It really stinks, guys. There are a lot of people that have dropped out of the labor market. I'd mentioned to you earlier that the unemployment rate fell to 4.8%, and it fell very quickly in September. And it fell because people stopped looking for jobs. The labor force participation rate is really low. This is an ugly, ugly indicator. And that is compared to JOLTS. JOLTS is job openings and labor turnover, and it's way up. The number of jobs that are available to be filled is at a record high, blown away record high. It has never been anywhere close to what it is right now. And if you compare the labor force participation rate to the JOLTS survey, we have a problem, and that is we got extremely tight labor markets. We got people, there's huge demand for labor and very low supply. And all you have to do is look at your Economics 101 textbooks to know that that is inflationary, that's wage inflation. And it's also producing some big disappointments. Your September's job report badly misses expectations, with payrolls increasing by just 194,000. It isn't because there are a lack of jobs available, it's a lack of people available to fill those jobs, and that's what caused the disappointment. And that is inflationary. So we have these two big inputs into inflation that we really have to be especially vigilant on: energy prices and labor prices, and they both look very inflationary right now. And then there's conditions on the ground. What happens if conditions on the ground? What happens if they become compelling? I looked at this quote from a press release. So it's earnings seasons. Earnings have actually been really good. So that's why the stock market is doing so well. But what are the commentaries? What are some of the commentaries that are going with earnings season? And here's one that I thought was really compelling here. It was inflationary pressures are two things: broad-based and sustained. Ooh, sustained and transitory don't match up very well, do they? And notice who it came from. This is Andre Schulten. He is the CFO of Procter and Gamble, this isn't a guy who's selling like, computer chips that are in short supply or commodities. This guy's selling soap. Soap and diapers is what this guy sells. And he is saying that in the practical everyday world, inflationary pressures are broad and they are sustained. And that's the reality on the ground. I have another good anecdote for you. And I took this photo just on Sunday. So just on Sunday, and you can see what it says. So, by the way, I kept the bald head in there just to prove that I did indeed take this picture, but you can see what it says here. I went to my favorite burger joint on Sunday, just before I jumped on an airplane to Florida, and this is what I saw on the door. We're going to be closed on the 24th due to staffing shortages. We apologize for the inconvenience. Look forward to serving you again soon. The place was closed because they didn't have workers. Those are these anecdotes, and this is the who are you going to believe, me or the Fed or your lying eyes, or who are you going to believe based on the data points that you see? Now, all of this seems like it's combining together to dispel our base case, to work against our base case, to disprove our base case that inflation is indeed transitory, that it is temporary, and it's likely going to be something that's going to work its way throughout 2022. We still believe that that is the highest probability situation, albeit the probability is falling because of everything I just shared with you. So if it's still the transitory thesis is the most likely, why did I just harp on inflation so much? Because it really matters to investors in a big, big way. It really matters to investors in a big way. We know that it matters to everyday people. Heck, if you're paying $4 a gallon for gasoline, that means you don't have money to buy other stuff. When that takes a bite. But what does it mean for investors, providers of capital? And this chart shows why this inflation story is so very important, even though our base case continues to be one of the transitory thesis. So what you see here is a regression of S&P 500 returns. Here's real returns of the S&P 500 on the y-axis. Use inflation. And you notice that that S&P 500 returns or stock market returns hang in there pretty well as inflation rises until you get to a certain point where you start to enter into a hyperinflationary period. And then the stock market serves as a far less important hedge or far less effective hedge against inflation above a certain rate. That's why we need to keep this in focus, keep inflation in focus. Equities have proven to be an ineffective hedge against hyperinflation. So even though we don't think it's the most likely scenario, we have to be especially vigilant because markets are very richly valued right now. And what's at stake is really, really important. So we have placed inflation hedges in all of our multi-asset class portfolios. We have shortened duration. We have increased quality. We have even increased dividend yield in all of our multi-asset class portfolios. Not because we believe inflation is going to be the steady state after 2022. We don't believe that. We just know that the stakes are too high and doing nothing to fend off the effects of possible, not probable, but possible hyperinflation. It's just a risk we can't bear. So we did make adjustments to our portfolios, even though it's not our base case for the outlook. Okay, there is some other news. I'm going to go kind of quickly here. I've talked a lot about inflation, the economy, financial markets, the elevator scenario, and so forth. But there is some other news, and here's one. You talk a lot about, or you've seen a lot in the news about budget negotiations. We're really in an interesting time in our history. On the left-hand side, you can see that that this is a debt held by the government debt held by the public. And you can see that it's expressed as a percent of GDP. I think it is. I can't see the left side here, but it's just shooting up, up, up. This is debt. This is government debt. Huge growth. This is where we are today. And this is what the expectation is for accumulated debt going forward. This is deficits. And you can see here's today. Here's the pandemic right here. A little recovery, but notice what the expectation is for deficits going forward. In the past, if you asked a policymaker whether or not these two charts were a problem, the answer would be unanimous. Yes, this is a problem. We have to deal with this problem at some time in the future. At some time in the future, we're going to have to do something about this. It was never a current situation where we had to fix it today. It was always at some point in the future, we have to solve this problem. That point of view is not the only point of view in Washington right now. There are many policymakers who have joined the conversation who say that these are a good thing. What you see on the left-hand side and the right-hand side are actually an indication that the government is working very hard to solve big problems that only the government can solve. And these are a good thing. All of the fear and hype about spiking inflation and interest rates is overblown. It's not going to happen. This is a good thing that we're seeing right now. And those voices have joined the policymaking discussion. They're in there. You see it every day. So this is one story we need to keep our eye on because it does show a paradigm shift in the nature of the conversation. Next is China. Now, I'm going to have to give you a full disclosure here. I've been a China skeptic for over a decade. I've seen their economy being built on debt and highly levered real estate transactions for an extended period of time. And I couldn't look at that situation and not make comparisons to what we saw in the United States leading up to the financial crisis. Well, we're seeing some headlines coming out. First of all, we're seeing rolling power grid failures in China. We're also seeing some indications that there's a bit of a collapse going on in the real estate market. 40% of the second largest economy in the world is comprised of highly levered real estate. And that is starting to really show some signs of trouble. There's a company called Evergrande. If you want to be cool, you call it Evergrande. And there's another company called Fantasia, a few other companies that are big real estate developers, and it looks like they are in deep distress. And that could have major contagion implications globally. Yeah, I'm not going to go overboard here because it doesn't look likely, but it could be. And the Chinese situation, state of the Chinese economy is something that we should keep on our radar screen. So that's other news. And they also just reported some pretty slow real GDP. 4.9% is really low for China. It's even less than the United States. Okay, so here's our summary, and I can't see the slides, so I'm gonna have to do this from memory. Throw away the economic history books, guys. Just throw it away. All the lessons that we learned in the past are not all that relevant today. The post-pandemic adjustment period, the pandemic adjustment period is so anomalous and so distorted that the lessons we've learned from history are really difficult to apply today. Growth rates are slowing to more normal levels. They're slowing to more normal levels. That's the essence of what's happening in the economy right now. It's not a turn to recession. It does, at least currently, it doesn't look that way. It just simply, we're getting back to normal pretty quickly. And that can create the distorted feeling of falling, even though we're still rising like the express elevator. It looks like the peak growth is probably behind us. All the roaring return to vitality that we saw after the vaccines were announced, looks like that pace of change is behind us now. But that's as expected. That's not something that's unexpected at all. This is just simply the way the economy works when it's as big as the US economy. Corporate earnings reports should provide some clarity about the outlook, and they look pretty good so far. What we're seeing in the stock market right now is really decent, really good returns. Seem to have shaken off that slowdown we saw at the end of the third quarter, and a lot of that is attributable to the fact that corporate profitability is pretty good in spite of everything else we've talked about. We are in a period, though, where sentiment can overshoot. Just as it overshot to the positive side earlier in the year, I fear that we've set the stage where sentiment can shoot to the negative side, overshoot to the negative side, and that's not good at all. Inflation is here, absolutely is here. It's likely transitory. We're going to stick with our transitory thesis, even though the probability is falling. Not sure what the next bullet says. My guess is that energy prices are a big driver of our supply chain disruption is a big driver of current elevations in inflation rates. Don't expect a big monetary policy response to inflation that's attributable to a supply shock. Big increases in interest rates have very little effect on inflation that's caused by a supply problem. So don't expect the Fed to really hit the brakes hard if it's pretty clear that the reason inflation rates are percolating is because of supply shocks. The two markets that we must watch, though, because of their the very broad implications, are energy markets and labor markets. Shortages in those two can slow growth quite a bit. It can slow growth quite a bit, and it can cause inflation that leads to a slowdown in the economy. So those are really the two sources of inflation that are probably the most meaningful and therefore require the most vigilance: energy and labor. Commodity prices, everything else that we've seen in some of the inflation data, while still important, are not as important as the labor numbers and the energy numbers. Inflation expectations have to stay anchored. That's what the Fed is doing. They're working so hard to try to keep inflation expectations modest, because that's going to keep it from becoming a self-fulfilling prophecy. We're going to be watching those Fed surveys very, very closely to test sentiment and see how it's changing. Above all else, investors should not try to figure this stuff out. We get calls on a regular basis saying, okay, what big move should I be making today with my portfolio, with my investments, to try to keep up with this very quickly evolving scenario? And the answer is, I have no playbook for you. This is the pandemic adjustment period. It's highly distorted. It doesn't have a playbook. The best idea is to stay diversified across most asset classes. Don't try to catch the internal rotations that I showed you in the stock market. Don't try to catch big shifts in the reflation versus deflationary trades. It's just simply something that is not possible. It's a game that shouldn't be played. As I mentioned, we put some inflation hedges into our portfolios and shortened our duration a bit, but that's only as a hedging influence, as opposed to something where we're trying to take advantage of a breakout of some sort in inflation or in the economy. There's no playbook, so don't try to play the game. So folks, that's what I have for you today. Thanks very much. Sorry that I wasn't able to give you a full commentary because I really couldn't see the slides very well. Thanks very much for your attention today. I think I've run a little bit over. Happy to answer any questions, or boy, even better than that, I'd like to hear what you think about all this. I'm just one guy on a webinar here. What do you think about all this?
Well, Scott, thank you very much. It was a lot of information in that 1 hour, and I think you nailed every time you said I can't see my screen. I think you nailed it verbatim. So I'm guessing it's not your first time going through this.
Not my first rodeo.
Yeah, exactly. I welcome anyone. If you'd like to put questions in the chat, that's perfectly fine. I will monitor that. You're also free to go off of mute and ask Scott, but I'll kick us off if that's okay, Scott, if you have a few more minutes.
Yeah, please.
Yeah, lots of good information, and a million different questions I think come to mind, and two in particular. The first one is, if we think about our audience and think about the folks that are dialed in here. We've got a lot of credit union CEOs, executive leaders who are thinking about and have been thinking about their strategic planning. What are they looking to accomplish, and how should they focus for next year? Is it safe to say, in one of the kind of deductions I made and just kind of trying to take all of this in, you mentioned recommendation for investors: throw away that history book. For economic forecasting, its growth rates are likely to return to that normal level. Stay diversified. There's no playbook because we can't actually predict what's going to happen. Does that translate to our credit union leadership teams that stay the course when you're looking into your strategic plans for next year? Don't go too far off the map. Or are things like the labor shortage, which is very prevalent, it's hitting credit unions, it's obviously hitting the consumers, are those things that should kind of skew the direction that these leadership teams should as they take this?
Yeah, but brilliant question. I appreciate it. So what we've been recommending is, first of all, is when doing strategic planning, that you follow this, for lack of a better way of describing it, a forecasting approach based on scientific method. And what that means is, just like I'd illustrated during the conversation, is you identify a multitude of scenarios. What could happen? And you don't do this randomly. You do it based on your read of the current circumstances and try to realize what the import is of the current major themes in the economy and the financial markets. Then you identify this range of possibilities. Then you assign the probabilities associated with those, and it becomes a living document. Meaning, as conditions change, the probabilities you assign to these possibilities start to adjust as time passes. My recommendation is to not have high confidence in anything. Now, I express high confidence in the transitory thesis. We use high, moderate, and low in our scheme. If I was to use a percentage number, this would be like the low end of high confidence. for lack of a better way of saying it, meaning that even though we think that it's the most likely scenario, there is a lot of uncertainties associated with that playing itself out, and I illustrated a bunch of those. So my recommendation is to identify a range of possibilities, assign probabilities to those, make it a living document, but don't have too much confidence in anything. The circumstances are so highly distorted that curveballs can come from any direction in this highly distorted, anomalous environment, and therefore staying nimble, not placing big bets on any possible scenario in the future is a good goal in the planning process. And just simply, don't put your stake in the ground too far, because you're likely going to have to uproot that stake and move it to some degree as the year passes. Now, there are some compelling themes, though, that do seem sticky, and you'd mentioned one, and that is the labor shortage. That's not something that typically, at least historically, has been something that's found its way to equilibrium quickly or easily. Those tend to be problems that stick around for a while. So if I was to assign a probability to a scenario for the future, and it included tight labor markets, I would, that's a pretty good bet. That's something that's likely going to be around for a while, and therefore you can make decisions accordingly. Just labor markets recover slowly. That's always been true. It's probably the one thing that in this recovery, it's going to look a lot like a traditional recovery is the labor market. It just tends to so grudgingly improve. And that's likely going to be with us for a while. So that's what I would say. I would say just don't put your stake in the ground too deep. Identify a wide range of scenarios, include outliers. Probability weight them based on your current judgment, and then adjust the probabilities as conditions change on the ground. That's probably about the best I could do with giving any guidance. You know all the variables, you know all the things that you have to plan around better than I do. But just the uncertainty is really the compelling theme.
Great. And I think that's adds a maybe new challenge to what needs to, we think about where we were last year, kind of preparing
Right.
for what is that post-pandemic going to look like now that we're
maybe an interest. There's a quick anecdote. So we write a letter every year called Letter to Investors, and it's a very long tome of a letter. We talk about the economic conditions of the time, the political challenges, the geopolitical challenges, and so forth. It's kind of a tome. It's a long thing. We send it off to our investors and to credit union executives like the ones attending today. And the first sentence of last year's was the most impactful event of 2021 or 2020 is likely invisible to us today. And boy, did we! That was the understatement of the year. I mean, COVID was not a thing at the time, and boy, just as short as 2 months later, we were on our ear because of the pandemic. So nimbleness, contingency planning, always having dry powder is usually a good situation in all environments. This one just happens to be one where the uncertainties are so heightened.
Absolutely. Great. I welcome any other questions. I do, if it's okay, Scott, if you have one more minute, I do have one more. I just want to make sure I'm not stealing the floor here if there are other questions. But as we talk about, credit unions and the audience we have today, two areas that, a lot of credit unions rely on very heavily in terms of their bottom line is the auto industry as well as the housing market, both of which are impacted and have been impacted and seem to be evolving or entering into this post-pandemic period quite differently. So I look at the labor shortage potentially is impacting the supply chain shortage, which is impacting the auto industry pretty significantly. And I know it's, to speak about these two specific industries is it's probably all wrapped up in the bigger picture in the same advice, but do you have any thoughts on those two markets in particular, since I would think that would be of kind of heightened interest to the credit union community?
I'm first a disclaimer, and that is that you've really wandered into the territory of my good friend and colleague, Steve Rick, who is our chief economist. So I'm sure he would have far more salient discussion points than I will. I'll say this, though, is that every market and every sector within the markets is highly sensitive to the cost of money, and money's been free. Money's been absolutely free, and money is not going to be free forever. So there will come a moment in the future, particularly in the housing markets, when what we're seeing today will reverse. And will it reverse dramatically? Will it reverse quickly? Will it reverse over time? That's anybody's guess, but conditions today are not going to be conditions in the future. There's disequilibrium in the housing market, and it's as plain as day. You can clearly see it. There's just no clear indication about when it's going to reverse. Less so in the auto market. The auto market is really distorted by supply chain challenges. And as a result, there's some unique conditions that are there. The auto manufacturers have been, the profitability has been quite strong, but they've been really subject to chip shortages of all things. So you're producing cars without microchips, it's a pretty difficult thing to do, and they've been really suffering there. I think probably one big headline is the electrification of the auto industry. And here I think that there might be some distortions. Tesla has a $1 trillion market cap. Did you ever think a company as small as Tesla in practice, with as low profitability as it has in practice, would have a $1 trillion market cap, multitudes larger than General Motors and any of its nearest competitors? Well, that's going to be one of two things. Either the whole industry, auto industry, is going to have to retool and look a lot more like Tesla, and that's going to take time and investment, or Tesla's just simply an indication of speculative excess that's produced by free money from the Fed. And that is, that's a wild card question. So that's probably about as good as I can do. I'm taking a financial analyst's point of view on these things. It's something that obviously strikes right to the heart of a credit union, because that's the business they're in. I think the housing market is probably clearer than the auto market in terms of its future, that it will correct. It just simply can't stay on this trajectory. Rents are off the charts. That's just not sustainable.
Yeah, I mean, rents are off the charts, and the availability of affordable homes is almost non-existent. And
yes,
the folks that are able to find a home and execute that transaction are the older generation with the cash offers, which is making it for first-time home buyers. And then when you throw the rental market on top of it, it's a challenge for sure.
Yeah, and a huge anecdote is homes are selling in most markets well above asking price. So what does that tell you? That tells you there's a structural change in the pricing mechanism for housing. There's something structural that's happened there. Typically, the transaction is that the buyer asks a price here, and they accept, sorry for the distorted picture here, but they accept the price down here. And what that means is that the seller sets the price here, and ultimately they accept a price down here. What that means is that the buyer has some sort of leverage. The buyer has leverage. The buyer has negotiation power to bring the price down. Here, it is completely flipped on its ear. This is a structural change because of the price of money, which is the interest rate environment. And that is that the buyer has, the seller has all the leverage. The seller has all that. They can start here, and then ultimately they end up accepting a price up here. They're accepting prices at above ask across the board, and that reflects structural change versus the normal. This is just simply a distortion that cannot continue forever. It must reverse at some point, and it will. The question is how quickly and when, and there it starts getting kind of murky.
Yeah, and then the implications of those that bought or sold during this time period. How do their balance sheets hold up? And we've seen that movie before, haven't we? We sure have. Well, Scott, I thank you very much for your time. We can't thank you enough. We value your partnership and relationship, and this was very informative. And I will offer to our attendees, if you have any follow-up questions or any further discussion you would like to have, please feel free to reach out to me at the CCUA, and I will look to provide you with an answer or direction to those questions. So, Scott, any parting thoughts or words of wisdom for us?
No, just thanks. It's a pleasure. It's always an honor to chat with you. Happy to entertain any further questions that you might have. And it's been a pleasure. Thanks for having me.
Thank you very much, Scott. Enjoy the rest of your trip.
Thanks, you too. Bye-bye.
And thank you everyone for joining.